Now that we have the S corporation and I'm paying myself wages, how do I take money out of the business? The IRS calls it distributions, but you can call it dividends or own or draw, whatever you're used to. Check out this summary from the IRS website to give you a better idea of what's going on. At the end of the year, the IRS is going to ask us to report a couple of things to them. Number one, box one is your profit for the year or loss. And then down here in box 16D, distributions. That's the money you took out of the business afterwards. So we recommend you take quarterly distributions out of your account. Now, some of my clients take it out once a year, some take it monthly. What you want to do is avoid using your business bank account to pay your personal expenses. We want to make a separation between the corporation and your personal life so no one comes in and says, you're just running it like your personal bank account. It's not really a business. We want you to keep you out of trouble there. So take money out, put it in your personal account, and then pay your personal bills with that money that you've taken out of the business. Remember, you're going to owe taxes on the profits of your business, and not all distributions are taxable. Sometimes you'll leave profit in the business and you'll have to pay tax on that as well. Now, why is it complicated? Because most business owners simply look at their checkbook balance to determine if the business is healthy and if it's showing a profit. But the IRS uses special rules to calculate profit for tax purposes. And there's several measures of business health besides your checkbook. One of the things we want to be careful of is that your personal expenses can swell as the business makes more money. We have a client who took out $285,000 in distributions last year, but doesn't understand how he could owe $100,000 in taxes to the IRS. That profit is taxable no matter how you spend it on your personal life. So if you're taking that money out personally and you're not setting aside some for your mafia-like partner in business, the IRS wants his cut. And if you're not giving them their cut, you get in trouble. And owing the IRS $100,000 is much worse than owing your credit card company or your bank some money. They're not as nice when it comes to collecting. So basically, we need you to set some of this money aside for your taxes, and we're going to talk about that later. In addition, sometimes distributions are taxable even though you don't show a profit. If you remember that IRS website I showed you a second ago, the profit was a $20,000 loss. It was in brackets, and the distributions were plus $12,000. They took out more money than the business actually made. And in this case, the IRS says you can pay tax on something called excess distributions. In other words, you pay tax on a profit you didn't receive. You pay tax instead on the money you took out. Now, one of my clients, he bought a truck at the end of the year for tax deductions because he was thinking, this is going to save me money. Let me show you his example real quick. He had a profit of $70,000 and he thought, I'm going to run down to the dealership and buy myself a $55,000 truck. And so he did, and he financed it. And what he wanted to do was deduct the entire thing on his tax return. And through bonus depreciation or Section 179, a lot of times we can do that. So his profit would have gone from $75,000 minus the $55,000 for the truck down to $15,000. Wonderful result. He's knocked his income down and saved taxes. We call these toilet bowl deductions. If you throw the money away, you don't pay tax on it. Now, unfortunately, he had already taken $40,000 in distributions out of the business. And the IRS says any distributions you take that are bigger than your profit are taxable as excess distributions. So if I take the $40,000 minus the $15,000 in profit he actually showed, he's going to owe tax on $25,000. This is not the result he was hoping for when he was looking for a tax deduction by buying a truck. So we want to be careful, make good plans, and sometimes just give us a holler and ask us questions. Will this help me or not? The key to making a small business like this work is really to control your spending at home. Don't let your eyes grow as big as that nice slice of chocolate cake that the waiter's bringing to your table. Sometimes you have a bite or two and say, that's enough. And in business, you have to control how much you take out for your own personal needs so that the business has enough money to operate on, is safe, and has money left over to pay for things like your tax bill if you haven't set it aside. For some of our clients, we recommend a separate bank account, where as they draw money out, they put some in that account to pay taxes later. And every 3 months, the IRS wants those estimated tax payments. They want you to prepay those taxes so there's no surprise at the end of the year. We don't want you to owe $100,000. That's no fun. Thanks for watching.